So in learning objective number 5, we're going to look at estimating inventory, and we're going to demonstrate how inventory is estimated. Right, so let's have a look at what we call the retail inventory method. So that is, how do we estimate the cost of inventory? Right, now sometimes businesses need to estimate an inventory balance. So for example, inventory could get destroyed in a fire or could be stolen. And so therefore the business needs to be able to recalculate what inventory they might have had on hand. So to do this, we use what's called the gross profit method. So estimates inventory using a company's gross profit percentage to estimate the cost of goods sold, and then we can determine what the value of the ending inventory was from that. So let's apply this and let's see how this actually works. So let's say our current quarter sales are $400,000. If our historical gross profit percentage is 45%, then of course our gross profit will be $180,000. So if we subtract the gross profit from our sales, the difference between the two, as we know, when referring to the income statement, is the cost of goods sold, because we take our sales revenue, we minus our cost of goods sold, and that gives us our gross profit. So our cost of goods sold here is $220,000. Now, our beginning inventory here is $200,000. Our net purchases are $90,000. So the cost of goods available for sale is $290,000, right? So that's what we had on hand throughout the period, not necessarily at one time, but in total throughout the period available for sale. We started with 200,000, we purchased 90, so we had 290,000. Now, if inventory has been destroyed for some reason or stolen, then how do we determine the value that we were left with at the time it was destroyed so we can put in an insurance claim, for instance? So in part 2 here, we worked out what our cost of goods sold was, which was $220,000. So if we subtract the cost of goods sold from the cost of goods available for sale, we have what we had over as ending inventory prior to it being destroyed or stolen of 70. So 290,000 was available for sale. We actually sold $220,000 worth. So our ending inventory balance is 70,000. And that's the value of what we had on hand before it was lost, stolen, etc. Okay, so that's how we apply this particular method here, the retail inventory method, which is specifically the gross profit method, to determine, in this case, what the ending inventory value was. Now, looking at that information, I would like you to apply what you've learned there to this question. So it says sales revenue for the year is $200,000. Gross profit is 30%. What is the estimated cost of goods sold? So if you could please answer that question right now. Okay, so we know that the sales revenue in this particular case is $200,000. The gross profit percentage is 30%. So that means our gross profit is $60,000. So the difference between this gross profit and our sales revenue is equivalent to our cost of goods sold. So we take our $200,000 in sales and we subtract our gross profit, which gives us our estimated cost of goods sold of $140,000. So $140,000 in this case is the correct answer. Now, if you're not sure about the logic associated with this calculation and you want to look at this in more detail, go back and have a look at the income statements. Remember, at the top of the income statement, we have sales revenue minus our cost of goods sold equals our gross profit for the period. So we're simply calculating what our gross profit is here in this case, which is 60, and we're subtracting it from our sales revenue to determine what the figure in the middle is, which is our estimated cost of goods sold, which is $140,000.